Good evening Namaste members. I welcome you all for the study circle meeting on the subject NBFC Statutory Auditors Responsibilities under Scale-Based Regulation and other RBI circulars. And to handle this, we have CA Raghu sir. May I request Chairman of Bangalore Branch, Manjunath M. Hallu, to kindly escort the speaker onto dais. Hand over the floor, okay? Thank you, Chairman sir. Today is our chairman's birthday. Despite his busy schedule, he is in institute from morning. Happy birthday to you, sir. I am privileged to introduce CA Raghav N, sir. CA Raghav N is a seasoned corporate finance and strategy consultant with over 19 years of experience across financial services, commodities finance and risk management. A chartered accountant by training, he partners with financial institutions and NBFCs on strategic planning, risk governance and financial control at board and executive levels. Raghav has led transformative initiatives from building finance and compliance function for startups to structuring PPP structures and executive NBFCs acquisitions. His work spans pricing strategy, regulatory compliances and financial inclusion, including pointing structured commodities finance program for rural economies. An experienced trainer and advisor, he regularly consults on financial regulation, enterprises diligence and risk management best practice. He began his career with ICICI Bank and IFMR Rural Finance and continues to support institutions across the BFSI spectrum. With this brief introduction, I present before you CA Raghav N, sir. Over to you, sir.
Good evening. Thank you for giving the time. I think middle of the week, if you are really interested in the subject, that's when I guess we can engage in this kind of format. All these many years later, my mind goes back to a subject called Banking Theory and Practice in my first year BCom, when we were first introduced to a gentleman called B.A. Saman, and then the first thing he said was, banking is borrowing for the purpose of lending. Right? Now, there are many. So at that time, at least I carried the impression that there is only one kind of enterprise which will borrow for the purpose of lending. But anybody who wants to lend beyond a certain scale has to borrow. Right? So if the definition is borrowing for the purpose of lending, how is an NBFC non-bank? Right? Because they are now very large in terms of scale, in terms of proportion of retail lending. They are already at 25, 28, 30% of the market. And that 25, 38, 30% of the market is only because there are certain regulatory limits beyond which it becomes very difficult to mobilize money. We don't have a very active secondary market for debt. All these kinds of structural issues sort of start coming up for NBFCs to grow beyond that. Otherwise, if you see, there is very little that sort of differentiates a very sophisticated NBFC from a small bank. I'm not saying larger bank because by design, and there are a couple of things in scale-based regulation itself you will see, by design the NBFCs are intended to be a certain level. Most recent example I will give you, not because scale-based regulation, I don't know if it's directly because of scale-based regulation or what, but the largest non-bank in the country merged with the second largest bank, right? Largest private sector bank, HDFC. At that scale, they found that they were tapering off, they were saturated. There were structural reasons for why they were not able to grow beyond, or they thought it was unsustainable to remain a non-bank beyond a particular time period. and so therefore there is very little. If you see HDFC at its peak, the way it was operating, there is only one small difference. They can't do demand deposits. That is all. And because they can't do demand deposits, there's consequently a few more things. They can't have a nostro, so they can't do forex, those kind of things, right? But otherwise, this is the only difference today between, because HDFC was taking deposits. They were accepting medium term, short term, they were doing CPs. Name the instrument, they were probably doing it before most banks. The only difference is they can't take demand deposits, right? Demand deposits are whatever you can go to the counter and say it's mine. That is not there. Everything else was there. So why I'm doing this very large preamble to before even going past the first slide is that there is a whole evolution of regulations within NBFC also. Whereas for banking there is a whole Banking Regulation Act, NBFC from time to time has been a regulatory afterthought, right? Even the part in the RBI Act which regulates NBFCs is 3B. Right? B is, I thought of 3, I thought of 3A, 3B also went out, right? So this was 1964. Most NBFCs then were deposit taking, so deposit was the main concern. Then in 74 they allowed non-depositing NBFCs. A whole long evolution, I will not call it. The main thing though is that increasingly, even though RBI was reluctant, I think it was becoming clear that the lines were blurring between NBFCs and banks. And if you see, we will cover something called the middle layer. A middle layer NBFC is not really middle, but we'll come to that. Is almost certainly the same size as a small finance bank, right? So then, the way they are doing loans, the way they are treating their customers, the way they are doing lending, everything is pretty much on par. Their technology requirements are also being brought up to that. And but there remains some arbitrage between. There is a reason why a middle layer, upper layer, NBFC wants to become a bank. They want to apply Navi recently, AU. Even though they became a small finance bank, they were not satisfied. They wanted to be a full-scale bank, right? So that's normal evolution for any financial services entity. The arbitrage which is there, right? That starts hurting because, say I am a very large NBFC, one of the ways I raise money is I will do securitization. I will do bilateral asset transfer. Then the loan becomes fungible, right? How does it matter where it was originated? It has to, there is with recourse, without recourse. Without recourse, if you do, then the bank is expected to service, if the buyer is a bank, they are expected to service it at the same standard or slightly better than. So the arbitrage is sort of gone away, right? And so the regulation also needs to recognize that the arbitrage needs to be kept at a minimum. Otherwise, on a transaction on a day-to-day basis, it becomes a challenge to regulate these entities. On the other side, there are 9,000 approximately, I don't know the right exact number, but 9,700 NBFCs in the country. That's a big, huge number. Now, if I tell them, all of them, I need audit committee, I need nomination committee, I need a full governance, I keep 4 independent directors, one of whom, all of this, if we load on to that small NBFCs, they will die. Right? So that's why there need to be a grade to the regulator's approach in how they want to deal with this sector, promote growth where growth is required, and also, because we live in the age of fintech, have enough controls so that any new innovation that happens in the market doesn't completely vitiate the whole borrowing, lending scene, because finance, lifeblood, all the, I will not repeat all the well-known idioms, right? So that is the whole context in which SBR has happened. You will be surprised to see the date, October 1st, 2022. There was an earlier SBR circular. The first SBR circular was October 122, which dealt with or introduced the concept that scale is important. Everybody should not be colored in the same way. There was an earlier concept of systemically important, non-systemically important. That line was drawn at 500 crores, right? RBI has done a few more things now, but then in October 2023, a more full-fledged circular for scale-based regulation was introduced, which is the one mostly that we will be dealing with now. What was missing in the 22 circular that came in the 23 circular was that they didn't actively say what will happen to the prior categories, right? So for example, if somebody is, so there were 3 levels in the earlier. There was a new NBFC, right? There was somebody at 100 crores and there was somebody at 500 crores. 500 crores becomes systemically important, and basically that was it. There were circulars, there was a whole evolution of, so RBI regulates NBFCs through master directions and circulars. There is no act, the only act is the Banking Regulation Act, Chapter 3B, otherwise everything else is what RBI says. They are exclusive regulator for NBFCs. It was not obviously clear from the 2022 circular whether the existing regime will continue or to what extent, and if there is a conflict, how those conflicts are resolved, and many other things. So for example, the SBR said that some things have to be done by middle layer. Those same things the systemically important circular said they have to do. Now, if I am between 500 crores and 1000 crores, what am I supposed to do? There are also, because there was a long history of making circulars, there was proper conflict between 2 different circulars. What should we follow, what should we not follow? If we are doing a omnibus reform, should it not capture everything, right? So now they have basically subsumed all the earlier regimes into the scale-based regulation circular that was directions that were issued in 2020. Right? So I'm starting at 2022, but that was because the concept and everything was created there. But 2023 is when the circular that we will now hereafter discuss that came into. 5-6 amendments have already happened. Latest was in May 2025. We can go through some of those. What the scale-based regulation circular does is it creates 4 levels of NBFCs, right? In ascending order of size. Size is the only broad parameter, and the sizing is as follows, right? Base layer is anybody, I'm just telling the basic stuff, there's some layering to all of this, we will come to that. Base layer is anybody who is up to 1000 crores asset size, right? Balance sheet size, total assets. Up to 1000 crores, whoever is there, they are called base layer. Then everybody else automatically is middle layer, right? Middle layer. Upper layer is basically not left monetarily defined, right? There is a bunch of evaluative criteria that RBI has said that they will follow, but it is for RBI to follow. They will follow that and they will notify you somebody is in the upper layer. The only thing they have said is at any given time, whoever are the top 10 NBFCs by balance sheet or asset size are always top layer. That's the only thing they said. Top 10 NBFCs, right? But otherwise there is no monetary limit. And then, otherwise upper layer NBFCs. Top layer, they've done something very strange. They've said that they want to keep it empty, but they have created a whole segment and kept it empty, right? The idea with top layer is that if it becomes so large that it starts plugging into different parts of the financial ecosystem, different parts of the economy, and then the size of the NBFC itself becomes an area of concern, or then they would want to more closely regulate those top level NBFCs, right? So this is the basic outline of this. Now, you're all familiar with GST. It's never that simple, right? So there is here also there is some cess, there is some layering, there is some more categories, there is some exceptions, all kinds of things they have done with what could have been a fairly simple, straightforward structure element, right? We will cover some of those. So, there is no stated objective, or there are very limited stated objectives in the regulation itself, master direction itself, but deputy governors, they have been speaking in public, and from that what we can glean is that the basic objective of scale-based regulation, while making it simpler for RBI themselves to regulate, obviously they will take care of their own first, but the basic objective of scale-based regulation is to bring in some level of common sense into the whole thing, right? Many of you, if you've audited NBFCs for a period of time, you will know. From around the time COVID started, right? RBI expectations from NBFC in terms of information, ad hoc information, is about something like 2 or 3 items per week. Right? So they keep writing for additional information that they didn't know they need, suddenly they want. For example, they said moratorium is allowed, right? It caused the whole pandemonium because there was a large statement made outside of RBI saying moratoriums will be permitted. Then RBI had to sit and reconcile saying which actor is doing what, how are they going to report it to me, what happens to their balance sheets, are we causing something else without realizing, right? So there was a whole catch-up. So since that time, it became unwieldy for RBI to deal with the old structure. So they wanted a new regulatory structure to integrate this. I don't know, around that same time, if you recollect, Diwan housing, ILFS, all kinds of bad things, bad apples were coming out from the NBFC sector. Similarly, there were stuff that was going on in banks as well. Here locally, there was a Guru Raghav N cooperative, then nationally there was that Yes Bank, huge problems. There is one contrast if you see when something happens in banking sector versus something happens in NBFC sector. When something happens in banking, the general public reaction is that, oh, maybe the bank did something, maybe RBI should have got it, maybe the auditor should have got it. Do better next time, right? Something happens to NBFC sector, and this is general feedback. You watch the listed NBFCs if you want the reaction to that the shareholders give, what's the news items in public, etc. One or two NBFCs, some significant NBFC, some news starts coming. The general public assumption is this whole sector is sort of rotten and then something needs to happen. Similarly, when a lot of fintech loans were overheating and there were a lot of public complaints, the whole sector becomes some problematic. Many cycles of microfinance crises have already happened. In general, when that happens, I think the whole microfinance sector. There is a reason to that. The reason is that the regulatory edifice based on which this entire entity is standing is not on very firm ground, right? And so the public carries a perception that this can end any time. Right? So I think in that sense, what they have done with SBR could be long term, could be something that organizes this in a way that then the NBFC, the sector, obviously RBI won't come and say this is a good sector to something. Their job is not that, but then the sector can use it to sort of make a good go of becoming properly mainstream. More world over, I don't know if you know, NBFCs are called shadow banks. There's something wrong with the word shadow, if you all anyway will understand that. So, but I think RBI has done commendably very early. They have put in regulations. They have recognized, and I think very recently there's a Supreme Court verdict as well, where they have cleared. In between there was a lot of discomfort that a lot of NBFCs were facing because the local Tahsildar wanted to regulate NBFC branches under money lender laws. Right? A lot of these cases were pending on a cyclic basis. These guys would start coming after the local NBFC officials, put some of them in lockup for a couple of days, see what happens. Those kind of things. I think recently the Supreme Court has clarified saying NBFCs are regulated. They are regulated exclusively by RBI, and so therefore no local regulation, including money lender laws, shall apply. Even if the money lender laws don't call out specifically that NBFCs are exempt from those regulations. So that's a big relief. So general formalization is good, and in that sense SBR is a step in the positive direction. While they have done this, they have also obviously taken the opportunity to strengthen what they expect in terms of technology, what they expect in terms of operations risk, what they expect in terms of governance. All of these they have built up to keep in step with the times. All are welcome, I think, and as the regulation gets some vintage, I think it will help with the general confidence level that the market has in the sector. Not that it's not there. A lot of very serious players are involved in this now, and then it's a growing sector. Plenty of NBFCs growing at 20-50%, which we are working. There are some immediate complications and implications for NBFCs though, because there is an enhanced expectation on how credit loss is recognized, how loans are done, how those loans are done in a fair way, fair practice code. There is now an expectation that NPA recognition and income recognition on NPA will happen on a day-to-day basis. So by end of day, when they close their business, they should have locked in their. That takes a little bit of a technological effort. I'll walk you through maybe why that is and what actual practice is going on and how you could reconcile with what the regulator expects. But there is a higher cost of just operating as an NBFC. Even if I don't do a single loan, there's a bunch of compliances that I need to make sure and ensure. So for example, very straightforward example I'll give you. Most non-systemically important NBFCs, they were reporting their financial parameters on a yearly basis. DNBS 09, yearly basis you give it is, and the timeline was really wonky. They wanted some provisional stuff by 21st May, and then they were okay to for you to upload it later. And September 30th was the time. Now, every NBFC, irrespective of size, every quarter end, the minute the quarter ends, 21 days from there, they are supposed to report their financial parameters on an online basis. What an NBFC has to do to manage annual financials versus what they have to do to manage quarterly financials. Hopefully they are running it by the statutory, even though for most of them review is not required quarterly. There is a cost. Straight away there is a cost. You are complicating the accounting function that much more. And sophistication, I guess, I agree, but it takes some doing. So immediate thing is, there are several such line items where there is a cost. And in some cases, because of what changes have been made, there is also a change in the way business models have to operate. Right? Straightforward examples, they have been tweaking with what an NBFC MFI can do in terms of qualified asset. Similarly, they have been playing with what kind of LTVs gold loan companies can do. Right? This is basically the regulator trying to say what should be the product that you write for your customer. Right? NBFC MFIs, they had been required to do 85% qualified. That was their initial expectation. It has now dropped to 60, right? But keeping it at 85 requires a certain business model. If I am also allowed to do up to 60, the same branch can do many more products. Maybe I can do larger loans. Because remember, the AUM is in rupees, right? But if I do a single mortgage top, it's 10 lakhs. Whereas if I want to generate 10 lakhs of MFI business, I probably need 15 clients, 20 clients, right? So the whole business model sort of also changed in some cases in order to meet some new norms. And of course, there is a whole new thrust on how their participation in the capital market is going, how liquidity is to be planned, how any systemic risk from at least middle layer onwards, NBFCs can be mitigated, controlled, contained if there is an event, etc. Right? So there is an increased focus there. That again will require greater planning from the NBFC. They are probably keeping higher liquidity because they do not know if they are fully compliant or not. I think we covered some of this. I'll quickly also try and capture why, of course, all this I am talking about so far I have spoken about only the NBFC, right? So why does it matter for an auditor, right? Because it's at the end of the day a balance sheet. Anyway, you have already, most of these days have already transitioned to Ind AS. Anybody who is greater than 250 crore is already on Ind AS. So there is not much variability there. So then why does it have any impact for the auditor? First step, I said that base level to middle layer, the qualifying criteria is 1000 crore asset size. Who will certify that? Right? So it is, the NBFC can only come to the auditor and say we crossed that, but then the auditor is expected to certify that they have indeed crossed 1000 crores, and so therefore from then onwards they are expected to be middle layer and comply with all items that fall in the middle layer guidelines. Starting from there are a bunch of other things that auditors have to do. In case of an NBFC, there are a few more people who might end up reading the audit reports that we generate, right? NBFCs borrow for the purpose of lending. So, not that other entities don't borrow, but the level of borrowing, money is the raw material for an NBFC. So, there is intense scrutiny there. There is also rating agencies, there is a regulator who pretty much wants. So, if you become middle layer onwards, so not only the financial parameters and NDA time, the whole set, including AOC 4, have to be submitted to RBI, right? So there is more uses, if I may, of the audit report that is generated. So that is one. The second thing is what things mean usually sometimes carry enhanced meaning for NBFC. I'll give you one quick example. There is this innocuous definition for dividend payout ratio. If you see that in the scale-based regulation, what they have said is, for the purpose of calculating dividend payout ratio, you need both dividend and the profit. For the calculation of profit, if the auditor has even expressed, not only as a qualification, even as an emphasis, that income may be overstated, income will be reduced for the purpose of calculating dividend payout ratio. So, in a common parlance, if you say emphasis of matter, it's something that you want to highlight to the members of the company, and it is something that maybe there's a note somewhere in the accounts, a notes to accounts, there's a note under some financial, and you want to highlight that for the shareholders. The moment you do that, there are a bunch of other stakeholders that the NBFC will have to then satisfy in terms of whether whatever has been emphasized is normal course of business. If it is not, then when will it go away, or whatever ensues thereafter, right? So there is that. There is another reason why, as a statutory auditor, it matters for you, because the level of compliance expected, the level of technology expected, the level of dependency on this technology for their daily operations, right? So even at the gate, when you apply for a new NBFC license, you are supposed to, as a management, certify that I have understood all the technology requirements that may come from running a business that entails the risks of an NBFC. And so we have understood those, we have put in place sufficient technology. So they have started it at the gate itself. Now that means at your end as well, you have to be at least conversant and capable of handling those technologies. Very simply, everybody will be on a LMS, loan management system, if not a core bank, right? They could be on core bank, but they won't be using the full flavor of the, or all the full feature set of the core banking. But they will also have something to do the rest of the year. Typically, the loan management system or the core bank doesn't go beyond capturing the portfolio, right? Now, when they say at the end of every day, you have to tag NPA, identify and complete those income recognition, reversals, etc. Will you be looking at the ERP or will you be looking at the LMS, CPS, right? Or are you looking at both, and is there a way to reconcile the two, right? I agree where it comes from. LMS is also available to the customer, right? It's a system of record. So tomorrow if there is a customer grievance dispute, or I have to report to CIBIL, I have to report to NFRA, I have to report to CIRLIC, I have to report to NSE, everything goes from mine. There are checks, including if they do a system audit or even the auditors want to do, to make sure that any report that comes, there is integrity to that report, there is no alteration. So if that happens, if I stop booking income on my LMS, when a delinquent customer wants statement of accounts, either I should be able to generate two statements, one which flows into P&L and one which flows to the customer, or I have to do all of this in my ERP, right? Now if they are doing either of these, the process that the auditor has to do to make sure that whatever is captured as NPA, whatever is captured as a reversal of income, where sometimes accounts come back from NPA status to regular status, wherever that happens, is there a good workflow, maker, checker, etc. to make sure that those are duly recognized. All these require at least good amount of familiarity with the regulations itself, and as well as the commercial business operations of any NBFC, right? So those high level, we'll look at some specific items as well, but so high level. So why does it matter? One, this is going to stay for a while. They have designed this to sort of remain for the next 10 years at least. So it is sort of worth your time to get familiar with these regulations, because everything is emanating out of this. So I'll come back to that. There's a whole bunch of circulars that they have repeat, right? So systemically important master directions, non-systemically important master directions, credit pricing guidelines, infrastructure guidelines, outsourcing guidelines, and this thing. Of course, they have repealed their own scale-based regulation. One of the regulations they have repealed is the scale-based regulations, and large exposures, defaulter identification. All of these have been folded into SBR. So the intent very much is to keep this omnibus. At the same time, SBR is not the only regulation that applies. This is the strange way in which this is now played out, because simultaneously they were doing two things to reduce arbitrage. One is they have been beefing up NBFC regulations in the form of scale-based regulation. The other thing that they have been doing is, wherever possible, wherever practical, they have been making horizontal proclamations. What is horizontal proclamation? If I do KYC, what does it matter if I am a bank? What does it matter if I am an account aggregator? How does it matter if I am an MFI or a regular NBFC? It doesn't matter. KYC is KYC. I have to know my customer. That's a horizontal piece. Similarly, there are transactions where one sort of regulated entity and another sort of regulated entity can work together. Most recently, famously, is co-lending. So, two lenders can come together every loan, and 90%, 10%. One junior lender is giving 10%, senior lender is giving 90%, both coming together to do. Now, one of them is a bank, one of them is not a bank. When they initially regulated this, they said banks shall do this. NBFCs will figure out later, right? What they have now done is they have made it uniform. Any two regulated entities doing co-lending will be on par with each other in terms of how they book it on the system, how they recognize their income, how they disclose APR to customer. There's an element called KFS, we discussed now, a few items there, are all fairly horizontal, right? So co-lending is now a new. Similarly, digital lending, both banks and NBFCs do digital lending. Admittedly, the digital lending circular is more directed at NBFCs, but there are requirements out of banks even in that circular. So that is the horizontal piece. There is something called transfer of loan exposures. Earlier, this was securitization guidelines. This has now been folded into transfer of loan exposures and securitization of standard assets. Right? Both these are horizontal circulars because any regulated entity can be selling to any other regulated entity. Sometimes they may be selling to another entity which is not essentially regulated by RBI. They might be selling to an AIF or to a mutual fund. Right? So there is no sense in seeing or directing this only at banks. Right? In fact, there were a couple of years in between where NBFC securitization volumes were higher, where the NBFC or the originator were higher than bank-led securitizations. Right? So bank securitizations in those years are only selling to us, nothing else. Right? So along with SBR, these all continue to apply. These are sunset, they are gone. So in that sense, it is going to be there for a while, and therefore every new regulation will be some form of insertion or some form of amendment to this, and so therefore it makes sense to get familiar with scale distribution. This also broadly aligns with regulations globally as well. So scale-based regulations is typically how regulators look at financial services globally. So in some sense, there's some alignment with the global.
So this layers I have a question.
Yes.
So it depends upon the turnover of loan.
So not turnover at all. It depends on the asset size, right? So if my total assets on balance sheet assets. So there's a confusing term called AUM also. AUM, I'll tell you, for example, I'll give you an example. I have a few loans which I have done on my own book, say totally 100 crores. Okay. Then I have a portfolio, another 100 crores, which I have co-originated with some other bank, say, right? Of which 90% that bank gave. I only give 10%. When I talk in terms of managerial reporting, I will say AUM is 200 crores, right? But for the purposes of what we are talking here, 100 crore of my own book plus 15 crore, which was my 10 crore, which was my contribution to the co-lending program. 100 plus 10, 110 crores is the total asset size. So asset size only, not turnover. There are some exceptions and everything about it. So, just to recap, base level is anybody whose asset size is lesser than 1000 crores. Regulatory, they have said that it is equivalent to NBFC, NDS. ND is non-deposit taking, non-systemically important, right? Problem is, in the earlier guidelines, there were some things which were triggered at 100 crores, some things which were triggered at 500 crores. Some of this carries forward in this as well. So there is a bunch of things, even though you are in base layer, you have to keep watching if some of your clients cross 100 crore and someone crosses 500 crores, what happens, right? Why is this tricky? Because if I was 100 crores last year, as per the balance sheet, I slipped below 100 crores. I have to continue to report till the next audited statement as 100 crores above. So say I was 1000 crores as on 31st March 2025. Right? Subsequently something happened, maybe I sold assets, maybe there was a truncation of assets, there was some loss I had to take, something like that. I fall, so say I was 1010 crores, I became 990 crores during the year. I have to continue to behave as if I am middle layer till the next financial year when my auditor is able to certify that this is the total Tier 1, Tier 2 before capital adequacy, this is the net on funds, this is the asset income pattern, you still remain, because it's possible that if the truncation is due to some large write-off, that write-off may trigger something where your financial income is not sufficient to qualify as a NBFC, right? And by the way, I'm not going into some basic elements, like for example, just a quick recap. Anybody who has a balance sheet where 50% of assets are financial assets and 50% of income is from those financial assets, they become NBFC. There are some qualitative criteria as well, but what is? Every year, the auditor is expected to test whether the principal business criteria is met and whether the entity is still eligible to hold license as an NBFC, right? So, till the next year when the auditor comes and says, here now is 990 crores, you will remain middle layer. Conversely, if I was 990 crores at the end of balance sheet last year, right? Say on 10th April or 12th April, 15th April, I became 1000 crores. From then on, I have to start behaving like I am already middle layer. I can't wait for my auditor.
But could there be a situation where a base layer could be put as upper layer if they are not meeting any specific criteria?
So there are certain kinds of, let me do this. There are certain kinds of NBFCs which are always upper layer, right? For example, if you are a HFC, so sorry, no, upper layer is not possible. Upper layer is only the top 10 to 15. You can be default middle layer.
No, what I mean is, you said asset criteria is one,
Correct.
but there are other
Correct.
risk-related criteria which could apply.
Correct.
So assume I am say 950 crores,
Okay.
but I have significant risk, whether
Correct.
it's
Sure.
defaults or whatever.
Hard to believe, but sure. Okay.
So does that even happen is what I am.
No, so you can't become automatically upper layer, because remember, upper layer criteria is top 10 NBFC shall always be upper layer. Then there is a risk parametric matrix that RBI maintains, RBI manages, and by that, if they arrive at the conclusion that you are upper layer, only then you become upper layer.
Yeah, that I appreciate.
So you can't automatically become upper layer.
I'm saying, for example, I would say below 1000 crores. But systemically I have issues, there are defaults, they have found other issues. I want to monitor more. Am I still monitored as a base layer, or do they kind of?
No, you are monitored as a base layer.
Base layer.
You are monitored as a base layer, unless there are other things, right? So, for example, if you are a deposit taking NBFC, you are always considered middle layer if you don't become upper layer. Right? Until the time you become upper layer, you always remain middle layer. Similarly, if you are an HFC, if you are a CIC, if you are an infrastructure finance, you will always be middle layer. Now, the tricky thing is, an infrastructure finance company, even if it becomes top 10, will always remain middle layer. But if an HFC becomes one of the top 10, it will become upper layer. So there are these staggered steps. One thing is you can't get to upper layer by yourself. RBI has to say. So just let me do this. There are, as of today, RBI has notified 15 NBFCs, whatever big names you know, Mahindra, Bajaj, Chola, Shriram. These are the 15 names that they have given are the upper level NBFCs. Top layer is still empty. There are about 600 NBFCs out of the 9,000 that I told you, which are currently in middle layer. Right? So until RBI said, hey, you 15, you are now upper layer, 5 of them are sitting in middle layer because they were not in the top 10. You can't automatically get to upper layer unless you have asset size. You can automatically be in middle layer basis what you do. So an HFC, for example, is always middle layer until it becomes upper layer. An infrastructure company, IFC, or a factoring company, these two always remain middle layer in spite of them, even if they become top 10, they will remain middle layer. So when you calculate the top 10, you have to remove IFC, you have to remove, there are no large infrastructure and factor companies, but still. They also carved out saying that until further notice, all government companies or government NBFCs shall always be middle layer. So there are some large behemoths, PFC, they will remain REC. They will all remain middle layer until any further clarification is required. So by asset size, you can become middle layer. By nature of your license, you can become middle layer, but not based on risk, not based on turnover. Yeah, sort of text, but yeah. Anyway, so the general idea is whatever is applicable to something which is base layer will also apply to somebody who is in middle layer, unless there is something in the middle layer guidelines which specifically contradicts what is there in the base layer. I'll give you an example. If as a portfolio you have 100 crores, if you are a base layer entity, you have to provide 0.25%. Right? If RBI had not said anything else in the scale-based regulations, that 0.25 would have applied even to middle layer. But they have come and said 0.4. Right? There are several things that they have not said for middle layer. For example, customer grievance management, fair practice code, KYC. All these are not specifically said for upper layer, they have said for base layer. So when they start the middle layer chapter in the SBR, they have said whatever applies to base layer plus. Drafting is not ideal. There are a couple of places where there is confusion. So for example, in the place where they say 0.4% for provisioning for middle layer, it finds space in the middle layer guidelines, but it does not specifically call out as middle layer. It says all NBFCs, right? So then there were a couple of years where NBFCs were not sure, where they have now recently issued a FAQ. They said no, you have to read it harmoniously and all that. But they could have taken care of it by saying all middle layer NBFCs and there are a lot of these places where this lack of clarity is not there. But because now they have clarified it like this, we can assume that wherever they have said something as NBFCs in the middle layer regulation, it means NBFCs are in middle layer who are not base layer, right? So, yeah, whatever applies to the previous rung in the ladder will apply to the next rung. Whatever is specified in the regulation is over and above that, right?
For each layer, the compliance is different for each layer. What will you recommend?
Yeah, there's a list of compliances. I will come to that. So essentially, there are a bunch of operational compliances. There's a bunch of governance compliance. Governance, fair practice code, grievance redressal, vernacular, outsourcing guidelines. Because if you work with third parties, whenever any NBFC works with third parties, they are allowed to outsource something which is not core to them. So, for example, they can't outsource underwriting, credit underwriting. They can't outsource KYC, but they can outsource somebody going and getting a document for KYC, right? But when somebody is going and getting the document for KYC as the representative of the NBFC, the NBFC becomes responsible for their behavior in the field. So that is what the outsourcing guideline says, right? So there are those on the governance. There are some more things on the governance, like for example, what kind of committees you should have. Remuneration committee, audit committee, etc. So there's some hierarchy there. But on the basic governance in terms of how you deal with the customer, how you report, etc., all this they have maintained in base layer itself. So those compliances are there. Then there are reporting compliances, right? So there are a bunch of things that an NBFC is expected to report. Twice a month they have to report to. There are 4 credit information companies in the country. Twice a month on a fortnightly basis, every NBFC has to report to all 4 credit information companies. Then every month, if whatever cases you are doing KYC and you have some new customers who are not new to credit, you didn't do the KYC by taking the CKYC, right? You can do KYC by taking CKYC records, but if you take a new document, then within 30 days of that person being added, you are supposed to report with all the documentation and add that person, get that person empaneled in CKYC. Apart from that, if you have enterprise loans where collateral is there and IBC might apply, then there is an entity called NSCL. You are supposed to upload to NSCL as well. And then if you are an NBFC greater than, so this is where something comes. Although they said 1000 crores is the limit for middle layer, at 500 crores you are supposed to start reporting to civil also. Right? So wherever there are counterparty obligations, you are supposed to report to civil as well. You are supposed to provide capital in a different way. All these start applying. There
Are there regulations for taking approval from target for doing any activity?
Sure. There are a bunch of regulations, there are a bunch of triggers, right? So in the scale-based regulation itself, there are a bunch of triggers where you have to take approval. I have not brought it out specifically because it's not specifically relevant to the auditor. But one, if there is a change of management, right? Change of management is defined as anywhere where there is more than 26% change in shareholding. Even on an accumulated basis, this is a cause for massive amount of confusion among NBFCs, but anyway, I will try and simplify. 26% change in capital table, shareholding, 30% change apart from independent directors in board of directors, or anything else which might constitute takeover as per takeover code, right? Semi-takeover, right? So anywhere where some such thing happens, you are supposed to take prior approval from RBI. After you get prior approval from RBI, you are supposed to give 1 month public notice in one vernacular, one English language newspaper, which is available in the headquarters of the NBFC, and only then you can undertake the transaction. Okay, so that is one.
That is the most acute kind of regulation, right?
Yeah.
Highest kind of regulation.
Yeah. There is other stuff as well. For example, if you want to make any foreign investments, as an NBFC, if you want to make any foreign investments, or if you want to set up any foreign subsidiary, or you want to set up branches in foreign countries. Some of these NBFCs do. I think you might have heard of an NBFC called Incred. I believe they are foreign investments. Those will be only after. You can't do it before. Certain kinds of corporate restructuring will require RBI prior approval. There are some smaller minor items, like for example, if you want to change, sometimes companies are forced to change their financial year. That change can only happen with approval from both MCA as well as RBI. You will get stuck in between because they will not tell who will do it first. They will ask if RBI will ask you if MCA is given, MCA will ask you if RBI is given. There is some level of sanity now. Both give no objection first, then you take approval one place, then you take approval another place, then you go forward. Similarly, if you want to change registered office from one state to another state, then it becomes very complicated. You have to take both approval, MCA as well as RBI. And of course, if you want to surrender your license, can only do your approval unless RBI cancels. Bunch of cases where approval is required. There are a few items where they also want to opine on auditor, right? Auditor appointment and senior key management personnel appointment. These are mainly for upper layer, right? Upper layer, by the way, is now on par with bank audit. Branch audits are required, joint auditors are required. It's completely on par with banks for upper layer. Rotation is applicable even at branch level. All of whatever is applicable for bank bench and bank statutory audits, more or less, I don't know, I'm not ready with a compare idea, but the headline items are all available. Qualification criteria are there. All qualification criteria look similar so just directly relevant auditor. If there is an upper layer entity that you are going anywhere close to, including for branch audits, you will have to see and make sure that either you are qualified. They may not have the level of infrastructure to do the empanelment the way banks are doing. So the owners may be on audit to make sure that they are qualified, because otherwise there is a big question on whether whatever report they have given, if they are not qualified, is valid or not. So those are places where you need prior approval. So broadly, there are 4 or 5 things that the SBR, which is broadly consistent with what they were doing before also, they are trying to regulate. One is capital requirements, right? At the entry level, it becomes net owned fund, okay? But at a higher level, it becomes capital adequacy, similar as banks. One interesting thing they have done with capital adequacy in the case of SBR is earlier Tier 1, Tier 2 capital was available to all NBFCs, right? Whether you were small NBFC, large NBFC, you could do Tier 1, Tier 2. I don't know if it is the intent, but the entire word Tier 2 is missing in the base layer altogether. So while some instruments, for example, if you do optionally convertible preference shares, redeemable preference shares, you do subordinated debt, right? These all qualify as Tier 2 capital. None of these currently in the current form that the SBR is drafted, they are not available for a base layer NBFC. You are only stuck with Tier 1. So CCD, CCPS, equity. There is one new instrument that they have created called perpetual debt instrument, right? One or two institutions have already issued PDIs. Those perpetual debt instruments are also not available to both base layer, in some cases mid layer. So first thing that they are trying to do is capital. Second thing they are trying to do is governance. Governance on 2 fronts. One is governance of your process. How are you engaging with the clients? How are you doing your business? Making sure that what price you charge is fair. Whatever price you're charging, the client has visibility in terms of what he's paying, both on an IRR and an APR basis. Any charges which may apply, are you communicating that fairly? So in order to ensure that you're communicating it fairly, they have added something called KFS, Key Fact Statement. So which is like a most important term. If you have ever taken a credit card companies are supposed to give you MITC, most important terms and conditions. So this is similar to that in terms of disclosures of what are the key contract elements that an NBFC is entering. Similarly, you are expected to have a fair practice code. Fair practice code should be available in every branch, in every language that is spoken, right? Usually there. So the fair practice code also should be available in vernacular. The latest fair practice code requires that you sign the contract with the customer in a language that the customer is familiar. So the contract that they sign with the customer have to, strictly speaking, be multilingual. Because I don't know if you want to enforce vernacular language if it goes to court, right? So I don't know if you want to enforce vernacular language in code, that becomes complicated. So I think what you are looking at is multilingual or dual language by language contracts. Right? So those are basic level governance. Then there is governance which is required of the company itself. Right? One is fit and proper criteria. This anyway RBI will ensure, but whenever you want to become an NBFC, first you apply to be an NBFC and you got your license. At that time, they have vetted whoever is your director and whether they are fit and proper. Whenever you add a new director, sometimes they give in the license accompanied by letter. Sometimes they give in that any new director appointment has to be with approval, right? So then in which case every new director you have to get approved. This may be relevant to you as auditors as well. So if they have added a new director in the course of the year, you might want to see if they are required to take approval. If approval is not required, in any case within 30 days of the appointment of the director, you have to give all information which is required as if you are taking approval post appointment of the director. Right? So one is fit and proper criteria. Second is how are the governance layers? Your board is there. Board is required anyway, company law itself. But earlier there were no committee requirements at all for non-systemically important NBFCs at all. But now, whether you are a new NBFC started yesterday or you are at 999 crores, you have to have a risk management committee. And risk management committee should have both direct board representatives and management representatives. So, per force, one committee at least is required in every NBFC, even if it's a base level NBFC. In the course of audit, you will have to make sure that A, they have appointed this committee, B, the committee has met, C, committee minutes are there, and D, this committee minutes have been presented before board meeting whenever the next board meeting happens. All this becomes part of your regular thing that they ask. More committees are required as higher order. So in the middle layer, you require both audit committee as well as compensation committee. You also require compensation guidelines, right? So in the sense that there are a bunch of restrictions in terms of how much you can pay your key management person in terms of range, basis size of the company as well as the profitability, right? In your net assets position, are you making a profit or not? And depending on that, there's a admittedly, those compensation guidelines only apply to upper layer. They don't even apply to middle. Then, of course, disclosure requirements are there at each level. So, basic disclosure is what we do in the financials. Then there are reporting disclosures that we do to RBI. Statutory auditor also is supposed to do two things. One is include an SAC, statutory auditor certificate directed at NBFC as part of the audit report. Apart from that, there is a return called DNBS 10, which has to be filed with RBI. The DNBS 10 will capture what I earlier told you. What is the asset size? What is the leverage? Any NBFC across size, right? Net worth, so total outside liabilities divided by net worth cannot be greater than 7. Right? Total outside liabilities divided by net worth cannot be greater than 7, no matter what else they say in terms of capital adequacy anywhere else. Right? So if you are running a bunch of stuff as optionally convertible debentures or NCDs, subordinated debt, there is a limit to that. Because it might result in you being greater than 1:7 pure leverage ratio. And yeah, so basic disclosures. So in your DNBS 10, these all will get captured. The other thing that gets captured is asset income pattern. Are they keeping at least 50% of the assets as financial assets? There are some things which are not financial assets. Cash, FD, money market instruments, these are all not called financial assets. Gold, bullion, these are not called financial assets. They are excluded a bunch of stuff there. Of course, once you reach upper middle layer, you are also supposed to create a full, as an NBFC, create a full compliance function, including a chief compliance officer and chief risk officer. A bunch of management positions become mandatory as you graduate from the regular. One is capital, two is governance. The third thing that they want to do is prudential regulations. Prudential regulations are, as you do your loans, you are not doing it in a manner that is detrimental to regulatory interest. So, for example, you are not giving all your loans to group entities. You are not giving all the loans without proper credit appraisal. After you give the loans, are you recognizing income correctly? Are you recognizing any right back of income correctly? If suppose some account becomes an NPA, right? NPA we will discuss a little more in detail. But suppose an account becomes an NPA. From the time it becomes an NPA, you are not supposed to, step number one, book any further income. All further income will be on a receipt basis. You suspend accrual and it will happen on a receipt basis. At the point that it becomes an NPA, you go back in time and whatever interest you have accrued until then. So let me take middle layer for simplicity, otherwise the number of days will change. If you are middle or upper layer, 90 days. Anything greater than 90 days past due. Meaning from the time that installment was due, 90 days have already elapsed. On the 90th day, you are supposed to reverse all the income you have taken from day 0 to the 90th day. 1. 2. From the 90th day, you can't book any further income on that loan asset. And 3. Whenever there is an actual collection, you are free to amortize. There are some rules for how you want to appropriate the payments to principal, interest, etc. But most NBFCs are mostly free to decide how they want to appropriate the payments. All interest income will thereafter be only on a receipt basis until the account becomes standard again. What is the meaning of account becomes standard? Not that he pays or he moves from 90 DPD to 89 DPD. He has to become 0 days further. He has to become standard again. Only then you can start booking interest income on an accrual basis again. Right?
Are there a difference between Windows and this SBR with regard to that?
Yeah, there are different. So just for the sake of convenience, 250 crores is the threshold when you become required to start following Indians. Until then, you are just following accounting standards.
And then classification, performing, non performing, all that.
So in India, the classification is based on your rule set, right? You have to create a
provisioning purpose.
You have to create a risk program, and as per your classification rules, which the management sort of decides, and every year the auditor gets an opportunity to it, you have to define criteria by yourself. What the SBR does is, they create segments which are mandatory for everybody, right? Whether you are in India or not, whether you have your own rule set or not, you have to follow this at least. Meaning what? Any NBFC where it becomes greater than 0 days, meaning yesterday he was or she was supposed to pay the loan, he or she has not paid the loan, today it becomes SMA 0, right? Special mention account 0. Then special mention account 1, 2, you are free to decide when you move. This is what you have. On the 90th day, for a middle layer and upper layer, we'll talk about base layer later. On the 90th day, it becomes NPA. What you can do with Indias is you can decide something more aggressive. You can't decide something more lenient. Similarly for provisioning, right? You are supposed to do ECL. Estimated credit loss is what you are supposed to do as per Indias. Now suppose you do, say it's a HFC, super secured book. Most likely the asset value is going up from the time you gave the loan, right? So most likely you will end up with standard asset provisioning as per your ECL lesser than 0.25. What are you supposed to do? SBR says do at least 0.0, right? So the ECL or the SBR, whichever is higher. In the case of booking NPA, SBR or your own credit model, whichever is lower in terms of number of days, is what the number. There are of course differences, but the differences are mainly because the Indias leaves most of the prerogative in the case of lending to the person who gave the loan, right? More or less. So, of course, in all of this, the auditor's opinion will matter, right? So, for example, if they are in Indias, as an auditor, you are expected to examine, understand the ECL model that they have, and make sure that the ECL is a true, fair representation of the underlying credit risk in that asset class. It has to be by instrument, it has to be by product category, all of that, right? So, differences will be there. But the way you should look at SBR is it's a minimum basic requirement, LCM sort of thing. Anything which Indians might have, anything which MCA might have, are all over and above. So long as they're over and above, you can follow those. Otherwise, at the very least, you have to follow SBR. Of course, if you're lesser than 250 crore, there's no conflict. For base layer, they have not done any concentration norms, any exposure norms, etc. Break in 5 minutes? 5 minutes. Yes.
So,
Yeah.
when customer crossed medical CPD,
Right.
told to suspend income.
Right.
So, from the 91th day, the income will be suspended, or will the client suspend as of 31st March?
No. So, 31st March is not gone. You were supposed to do at the end of every business day.
Yeah.
Okay. Now, at the end of every business day, you will suspend any further income accrual in that account. What you will also do is whatever income you already booked for the first 90 days or whatever, those also you have to write back. So that income must be de-recognized. And until that client becomes zero DP, standard asset, you can't start accrual basis again. You have to do it only on receipt basis. Yes, sir. So there is no concentration or group exposure norms for base level NBFCs. But in any case, they have said in some other advisory effectives, they have said follow it, it's good for you. Right? The reason they don't have it is because if I have a very small NBFC, if I am only at 10 crores or something, 10%, 25% of it is almost nothing. I can't do business. Right? And so it might become a blocker to me. And of course, I may not have the sophistication to ensure programmatically, technologically that the exposure norms are not violated. So there is no concentration norms. Concentration norms remain same as before from middle layer onwards. 10% for any single entity, you can't take greater than 10% of your total portfolio as exposure on only one entity. And if it is a group of, so they have a very interesting definition of interconnected counterparties, right? So to a group of interconnected counterparties, you can't, so group is defined as anybody who is doing transactions. If liquidity stops for one, it bothers the other. It's a whole very interesting definition of 10-12 line items, which is the most extensive definition. It matches what they have made required for banks. And so anywhere where the group of interconnected counterparties is involved, you are supposed to do 25%, not more than that. There are some exceptions if you do to your own subsidiary, etc. There is some exception there. Or to your own holding company, you can actually. There is also some sectors which are identified as sensitive sectors, agri, defense, etc. There no restrictions on base level, no restriction on mid level. For upper level, there are some exposure caps there. Then, of course, the final thing is business restrictions, right? Technology is required, core banking equivalent or LMS, where approval happens automatically, audit log is maintained, any business continuity event is taken care of through a proper business continuity plan, maker checker for every transaction, workflow for multiple approvals. All of these they have defined as what is required for core banking. Most NBFCs may not have core bank, but they'll have a loan management solution which will more or less cater to everything. The difficulty comes when we have to see what is the system of record, right? As far as the NBFC is concerned, for the client, the system of record will be the LMS, right? So if I want an account of statement of account, if I want a no objection certificate, if I want a balance statement, all of that comes from the LMS, right? Whether that same thing is flowing to the financials or not, in most cases I think the answer would be no. They will either through an API or through some integration or by manually putting the control totals of the LMS be managing the balance sheet P&L process. Okay. So now when stuff like provisioning, NPA recognition, etc. comes, as an auditor you have to be extra careful that you understand the process of how they are calling something in NPA and how that recognition of NPA, say in LMS, is flowing to the ERP system as well, right? So that is something you have to take care of. They also want to look at IPO financing limits and nothing greater than 1 crore for NBFCs per person. Of course, that's also subject to the concentration norms. There is no specific restriction or statement about notes to directors for base layer entities, but that doesn't mean there is nothing there. You will anyway have to look at 185 and see if that is applicable, complied with, etc. But there are extensive regulations for middle layer onwards if you want to do loans to directors or senior officials. Nothing preventing you from having an employee loan policy. Just make sure that directors and senior management is kept out of those employee loan policies. Otherwise, all the restrictions that come here will apply to your lower level employees as well. Yeah. So this basically I have given you a briefing of what the ambit of or gamut of SBR is. We can come back and look at some specifics, some scenarios, etc. I think a good point to break, unless you have any questions. Yeah, so I think we were looking at the new regulatory regime of the SBR. Looked at the basic outlay of how it is laid out. There are a couple of more preparatory things I wanted to highlight. We can look at the specifics. Sir, ಎಷ್ಟೊತ್ತರೆಗೂ ಪ್ಲಾನ್ till this time 8 so huh? Yeah, so the one of the important things, this is a very significant change that SBR has done. You know, all NBFCs are governed in the same circular, is that they have said that all group classification shall be done on a group basis, right? So if you are 100 crores, you are part of a 1400 crore conglomerate, of which a few others are also NBFCs, right? Then the regime that will govern you will be as if your whole group was 1 crore, right? That means, so I just taken some illustrative numbers. There is an NBFC, so the group is as follows. There is an NBFC ICC, there is an NBFC MFI, there is HFC, there is NBFC IFC, which is infrastructure company, and there is a P2P company, and there is a NBFC ICC. Okay, ICC is investment credit, right? Which is just giving loans to group entities, etc. There is no customer interface and there is no public funds. They are doing it with their own funds, right? Overall, the total asset size, if all of these NBFCs of various flavors were taken together, there would be 1400 crores, right? So now let's see what happens to each of these entities one by one. First is your ICC, right? Investment credit company. There, the asset size is 350 crores, should have been base layer, right? But because as a group they are now growing about 1400 crores, we will have to consider, and you will have to audit this as if it is a middle layer company. Okay? All the provisioning norms, the prudential norms, etc. will happen as if this was a middle layer. Then there is an MFI which is 150 crore, again base layer, right? Again same logic, greater than 1000 crores, so we will now have to consider it as a middle layer. Then HFC. Right? HFC is 250 crore. We don't care because even if it was just the minimum statutory required of 10 crore, it would have still been a middle layer, right? So HFC will remain a middle layer company. Now the infrastructure company is 100 crores, right? This will again also always remain a middle layer company. Even if this conglomerate is a top 10 conglomerate in the country, the IFC will remain a middle layer, right? Because all IFCs are by default middle layer. Then without public funds being taken and without customer interface being there, the company, doesn't matter what the size is, will always remain a base layer. So this will remain a base layer, right? So when you are auditing and it is part of a group, you will have to agree with the statutory auditors of all the other group entities what you are classifying all of this as, because somewhere consolidation will happen, and so that we will have to, they will become responsible for your work product. So this has to be agreed. This is one significant change. Systemically, risk is being reduced. So to your earlier question of whether by risk parameters can they skip a level, this is the only risk parameter. You are part of a conglomerate which also has other licensed regulated entities. This is the only risk parameter basis which can jump a level. Any group is standard definition. I don't think 20% equity is the threshold. RBI has 20% equity threshold for pretty much everything. For classification of group, wherever they use group classification, they use 20% equity. There is one interesting element which is common branding, right? That is there in some SEBI regimes, but do not usual. So you may have to take note of it. Yeah, so there is one cascade which they have created which is unintentional. So whatever I am telling you here is all applicable to base level NBFCs, right? But because I don't know if they drafted it intentionally or it is found in the final draft, what is happening is if you have 100 crores and above asset size, some things in addition apply to you. If you have 500 crores and above, some more things apply to you even though you are all still in base layer, right? So basically for base layer, all layers, statutory auditor certificate, filing of financial information, DNBS 9, 10, grievance redressal mechanism, fair practice code, KYC, reporting to credit information companies, and every year annually you are supposed to give a couple of board resolutions as a company and you have to ensure as an auditor. One is that they have not taken deposits in the year that will apply, and they will not take deposits in the year to come, and the company is not in the practice of accepting deposits. That you have to say in one resolution. And the other resolution is if there are any investments, right, those you will have to, the investment policy has to be reviewed once a year. So these apply to all companies, base layer, 100 crore, 500 crore, doesn't matter. Another thing that applies is your risk committee, which is now new as per SBI. So whatever size you are, your risk committee, remit of the risk committee changes, scope might change a little bit because you are a small company, big company, but the committee should be in existence for even the smallest entities. Once you reach 100 crores, audit and nomination committee becomes recommended, not yet mandatory, it is recommended. And then there are certain more layers to grievance redressal mechanism. Namely, earlier you would not have been in ombudsman's claim, but the minute you touch 100 crores, you are now accountable to the ombudsman for any customer complaints. Right? So, if you are required to be on the ombudsman, there is a system called CMS. You have to enroll your NBFC on CMS, and I think there is one mandatory training in which even the auditor is expected to attend for the first time that the entity is onboarded to ombudsman. Basically, the ombudsman can give awards and degrees basis customer complaints, having reviewed whatever merits, etc. Even complaints which go to credit information companies, right? Your civil complaint, right? Whenever you make a civil complaint, both civil as well as the NBFC or bank who is concerned are accountable to first RBI also, right? So the escalation point, if you don't meet all of this, is RBI ombudsman. They have given a separate circular for complaints regarding credit information company complaints. Collectively, both the originating NBFC as well as the credit information company will have 30 days. How they want to split the 30 days is between them. If they exceed 30 days, RBI will, there is an automatic penalty that comes 5,000, I think 5,000 rupees a day. That comes, that will get apportioned basis how much delay each of the entities do. Right? Now, as soon as RBI said this, most, I think all CICs have written to their respective members saying, we will split the 30 days as follows: 21 days for you, 9 days for me. Right? Now, when they give you the complaint as an NBFC, your clock starts that day. So long as you give it within 21 days from that time, ideally there should be no penalty on. Of course, RBI ombudsman will decide, but ideally there will be no penalty on you. If despite that the credit information company takes say 40 days to reply to the complaint, the entire say 10 days is 50k, the entire 50k has to be paid by the credit information company. However, if you gave on the 23rd day and they delayed a further 8 days, then you split it in a 1:4 ratio.
This cascade is available in one place in the literature or it is not?
So this cascade is not even mentioned in the literature.
You have a point.
Yeah. Because you have to understand, the minute somebody crosses 100 crores, there are some things that they were not doing that they have to start doing. For example, they might want to start putting in place an audit committee. Ombudsman they have to register. There is another thing that they have to do. Your liquidity and investment policy has to be there. So liquidity management policy becomes mandatory as soon as you cross 100 crores. So all these things in various places say, they say any NBFC greater than 100 crores, which is a relic from whatever regime they were earlier, but they have not updated it to say base layer or middle layer or whatever they wanted, whatever the regulatory intention was, so it continues. So you have to follow.
Even operational and governance, that also is not available in one.
No. They have done one thing for operational risk though. Whatever operational requirements are there, they have put in some, it's 2025, there's a new guideline called operational risk guidelines. Guidelines means they're advisory, they're not enforced or applicable, but recommended by RBI. So they've captured all the operational risk requirements as an annexure there. Might be useful. I haven't checked if they've missed anything or it's scattered all over. So it's just easy for them to communicate if they say this layer, this layer, this layer. They could have put in a comparative table. I don't think they're done.
Your PPT is more useful.
You can share that. No idea on this. And then once you become 100 crores and above, you are expected to submit all your EOC, MCA filings. Also, along with doing DNBS 9, you are also expected to submit your financials to the RBI. Of course, when you become 500 crores or more, CIRLIC start becoming applicable, which is for stressed assets. And so, the whole stressed asset framework you have to put in place, you have to adopt a stressed asset framework, and then this is for mostly large exposures. So where you have exposures of 5 crores or more per loan, only those will attract CERLIC. So those first empanelment becomes required CERLIC and then reporting will start. So that's something that starts. If you have foreign investments, then there is an extra document which is FATF compliance certification that you have to do once a year if you find it goes on. There is a whole cascade which is more logical, which is base layer, middle layer, and upper layer as well. First is prudential norms. Prudential norm basically for base layer is you have to maintain net owned funds. That's all. Not much else is there. Asset classification provisioning is for all entities. So you have to classify assets as SMA 1, 2, 3, standard, substandard, doubtful, loss assets based on your vintage of collection as well as the expectation of how much you will collect that. At 500 crores, the provisioning and everything remains same, but you will have to improve your risk models, etc., and update your risk models, because if you're 500 crores and above, you are expected to do provisioning, risk model, all of your policies on a product by product basis. It's not only for the whole entity. Each product should have a policy, right? And then of course provisioning changes. So there's one error here. Before I send it to you, I'll correct it. That mid base is not there. I don't know, some error there. So if your base layer, standard asset provisioning is 0.25%. If you are if your middle layer, it is 0.4%. Okay, on standard asset provisioning. And upper layer, there is a bunch of criteria, right? Which is basis whether you are secured, unsecured, if the security is gold, if the security is automobile, whether the security is mortgage, if the mortgage is registered or equitable. So there's a whole table if you are upper layer. But to compare apples and apples, if you have pure personal loans, unsecured loans, in upper layer you will probably be doing 0.6%. Could be as low as 0.25. Mortgage fully covered is 0.25, but most likely is 0.6 for personal loans. Yeah, some I thought I'll do some comparisons a little more as well. This is still base 100 and 500. I'll just only point out that whatever changes, if you're less than 100 crore and you don't have a customer interface, you don't need fair practices code. But if you cross 100 crores, even if you don't have a customer interface, you need a fair practice code, because your customer might be an enterprise or a non-individual, but still a fair practice code is called. If so, like I said, risk committee is required across. If you cross 100 crores, on nomination audit committee is recommended. If you cross 500 crores, nomination audit committee is mandatory. Plus, you have to start looking at fraud detection, fraud risk detection directions. There's a separate direction for fraud risk, specifically directed at NBFCs. So you need to put in a set of procedures, which is a layer on top of your operations layer, to see if frauds are happening and report on fraud matters. So that's triggered at 500 crores. And of course, FATF compliance is only if you are 500 crores and more. Yeah, there are some more changes in terms of securitization direct assignment. You can ignore that because they have now also issued a secular horizontal thing, the transfer of exposures guideline, where they treat all entities the same. For base layer entities, there's only two things required in terms of capital. One is you have to have net owned funds. Starting, as of now it is 5 crores, okay, minimum. As of March 2027, it will become 10 crores. So minimum of 10 crores. I'm assuming ICC. If you are an MFI, it's already 10 crores. So on and so forth. That is the only requirement in terms of capital. The other requirement is you can't leverage greater than 1:7. Total outside liabilities divided by own funds, net own funds should not be greater than 7 times. Right? So that automatically enforces a kind of capital adequacy, I guess, but it's not specified. The other thing is they have not provided any tier 2 flexibility for base liabilities. So earlier you could do tier 1 capital, tier 2 capital. You might be familiar with this, all banks do this, right? Base equity, securities premium on the base equity is tier 1 capital, right? If you do CCDs, compulsory commercial preferred shares, perpetual debt, all these also are tier 1 capital. Tier 2 capital is you can do optionally convertible or redeemable preference shares or optionally convertible debentures of a certain tenure, or you can do NCDs which are greater than 6 years, right? Then they become something called a subordinated debt, so long as you do it on an unsecured basis. All of these are instruments which are not available to the issuer. They are not even available to somebody at 500 crore plus. It is not available to any base tier entity. There is only tier 1 for base. What they do recommend though is, I don't know if you would have seen some table which says risk weighted assets, right? Risk weighted assets means if you say in your balance sheet that your cash balance is 5 lakh and your bank balance is 10 lakh, there is no risk posed by a third or counterparty to whether that value of that is 10 crore at all, or is there any depreciation possible in the value. Whereas if you have some loan book, right? Say that loan book is unsecured loan. You are supposed to risk weight it at 125%. Say you have vehicle loans or gold loans, you weight it at 100%, right? So basis this, you calculate what, of course, just a side note, intangible asset doesn't come in anywhere here. Anything you want to call intangible asset, RBI will say first deduct it from all. It is 100% deduction, so they don't deal with deducted items in your risk-weighted assets. So you calculate risk-weighted assets, and your capital adequacy is supposed to be calculated basis that. So if you are an upper layer entity, you are supposed to have middle layer entity, you are supposed to have 9% tier 1 and overall 20% capital. 1:7 anyway continues. But tier 2 is available middle layer almost. No tier 2 is at all available at all for base. I think we've dealt most of this. The only thing I didn't mention is if you are a core investment company, right, greater than 100 crore size, then instead of 7 times, your total leverage ratio can only be 2.5. 2.5 times is what the maximum leverage you can take, no matter what. Because they are an investment company, mostly investing only in the group entities, they don't want to mask borrowing. Yeah? The rest of it in some form or fashion, I will share the slides, but I think we've spoken. Concentration norms we've spoken. Capital adequacy we've adequately dealt with. Provisioning we've covered. Yeah, and statutory certificate we'll talk more in detail next slide, but we've already covered some of that. KYC again. KYC is applicable across unless you don't have customer interface. So some entities are there only which will deal only with their own group entities or something like that. There is KYC expectation even on those loans, right? But the KYC circular doesn't apply in total on that those loans. That's all. Another thing to say in terms of KYC, sometimes you might find NBFCs are doing loans to their own employees also, right? Either as part of an employee loan program, which is different from staff advance. Staff advance has to be interest-free recoveries from future salary. That is not it. They might actually be doing loans to employees, right? All KYC, all other applicable norms would be as if they're applied because they are a client. They can quit tomorrow and then the loan will still remain, right? So KYC will apply, reporting to CIC will apply, everything will apply as if it applies to a customer. So you might have taken KYC at the time of joining, but along with the loan record also you should have the KYC records available. And somebody should have done re-KYC at the time of giving the employment. Yeah. So whatever was erstwhile DNBS 89 is replaced by DNBS 02, which is basically all your financial parameters. There is a portal called SIMS, where centralized information management system that RBI has. All NBFCs need to be empaneled there. There is no need for auditor to empanel. Whatever auditor submissions are there, you can affix your DSC and the company can upload on your behalf. That is possible. So DNBS 02 is what is to be filed every quarter from the time the quarter ends, say March 31st, June 30, September 30 and December 31st, right? So on April 21st, July 21st, October 21st and January 21st, this return has to be uploaded. Apart from this, once your statutory audit is complete and you sign off on the financials, within 5 working days, you are supposed to update the final. So whatever you had uploaded on 21st April, assume your audit was completed on 15th September. By 20th September, you have to update the April 21st submission to reflect the financials. So this is the main reporting any NBFC is doing vis-a-vis RBI. Extensive, there is a whole taxonomy for what they are referring to, how you have to capture exceptional scenarios, etc. All this the company is expected to do, but I think there will be oversight expectations. They also report what the auditor will report as asset income pattern and as capital adequacy. Only thing is that the stat auditor has not signed it. The DSC is not yet affixed. But in best interest to make sure that whatever they have submitted in their DNBS 02 is what you will submit when DNBS 10 happens, because otherwise not as completely automated. The minute there is a large variation, some rule engine is there, I am sure, which triggers something will immediately you will get away. Recently I had one case where, yeah.
On DNBS Code B, I have a procedural query. Can I ask?
Yeah.
There is one section called actual flows.
Actual?
In the DNBS Code B, SL worksheet.
Correct.
There is one section on the right side that says actual flows, inflows and outflows.
Correct.
Is it cash flow or fund flow? That's the question.
Cash flow.
It's cash flow, but how can you report it? It's in the direct, our cash flow that we prepare for normal purpose.
Correct.
We follow indirect method.
That's a tricky one actually. So you have to do both.
Very difficult to match.
Yeah, I may not match. So the only thing though is what they're trying to do is calculate interest rate sensitivity, right? So an indirect method will not work for them, even if you think it from the perspective of if you do indirect, right? You have to arrive at the rate sensitivity also indirectly. That may or may not be accurate.
For decision making, that is not sufficient.
Correct. So management may have to maintain direct cash flow. This is how you will verify is a different question as auditor. So yeah, but 4A, 4B start getting applicable at the time you become 100 crores or more, right? Some confusion there. Most people do 4A, but don't do 4B at 100 crores because the way it is worded currently allows some room, right? I think in a couple of cases we also responded that it is not applicable. Let's see if there's an adjudication that I can update you. One other thing I wanted to say was that in the recent past, right, last couple of quarters, RBI has started sending out matching, checking variations, asking for reasons why there's a jump in something or the other, based on March and June filings. That comparative has already started. So it's a fairly intense process for whoever is managing this at the NBFC. Most times I think if there is a query, RBI query is serious enough that the auditor will also get involved. I think I jumped it. 4A and 4B are basically liquidity and interest rate sensitivity statements, right? Where in the future, if there's potentially a mismatch of cash flows, either because you used long-term funds for short-term purposes or short-term funds for long-term purposes, or you have uncovered positions because you are using debt where you should have used equity, right? Those kind of things will show up on these statements. So RBI wants to make sure that there's a margin of or room for variation in some of this. So there is a requirement again to do quarterly in the case of 4A and 4B monthly. Yeah, DNBS 08 is only 500 crores and above. Like I said, it's for exposures greater than 5 crore to a single borrower. Monthly, 15 days from the reference date, you will have to submit. Even if it is nil, once you are empaneled with SELIC, it is expected that you submit monthly some return. Then DNBS 10, right? DNBS 10 is the statutory auditor certificate. It's basically an Excel sheet where you calculate net out funds, asset income pattern, whether financial assets are greater than 50%, whether financial income is 50% at least coming from, or income out of the total income, at least 50% is financial income coming from those financial assets, right? That has to be submitted within 30 days from the time the UDL is obtained, essentially, right, for that audit. Within 1 month, actually we don't say 30 days, within 5 working days, if it is middle and upper layer, within 30 days if it is a base layer. You have to submit. The submission will happen through the credentials of the company, but the auditor's DSC will be affixed to the submission. Form A is basically, Form A is applicable from middle and upper layer onwards. But what RBI has clarified is every NBFC on an annual basis should better submit Form A. They in fact even follow up on mail if even base level entities don't submit. The idea is, even if the auditor is appointed for 5 years as the company law permits, and because rotation and all of that is not yet applicable to base level, you might not actively appoint an auditor that year. You might have appointed for 5 years, but you will have to submit Form A to show to RBI that there is no change in audit. You asked me if there are places where RBI requires prior approval before doing something. One of the things that they require prior approval for is if you want to fire your auditor. If you are going to terminate the audit, so which is different, two ways, right? One is he is not reappointed, which is different. But after appointment, if there is any change there, that now requires prior approval from us. This is as from 2024, it was not there before. No. Which is why they tell even base layer entities Form A is required. So financial soundness indicators mostly are all part of the DNBS 02 itself. You can take a look at that. Mostly same. DNBS 13 is a very strange. Most NBFCs will report 0. Timeline is the same as your DNBS 02. So every quarter, within 21 days from the end of the quarter, you have to submit. DNBS 13 is basically if you have made overseas investments as an NBFC. I think you can count in one hand on 2 fingers the number of NBFCs that are made out of that. But out of whatever wisdom they have said, every NBFC, irrespective of what size, will need to even if it is nil, submit this within 21 days from the end of the report. I think we discussed most of this, right? Basically, IRAC norms, right? Income recognition norms is income recognition, asset classification, and provision. Okay? All together are called IRAC. There is now a requirement to do this on an everyday basis, right? Apart from that, as of 2023, they introduced something more, which is called SMA, special mention accounts. So earlier there was standard, substandard, doubtful, and loss. Right? These are the only categories. Substandard is at 90 days or 120 days or 180 days, depending on what it is for the respective entity. And until that time, there is no review imposed on the management to see whether what loans they have given are in good order. What RBI has now done is you have to do something called SMA, and you have to write your criteria for it. Anything which was not paid on time, right? DPD 0. If it is not DPD 0, anything which falls under DPD beyond that becomes SMA 0, right? Then thereafter the entity is supposed to define what it wants to call SMA 2, what it wants to call SMA 3, right? All within 90 days, right? As of now, base level entities are required to classify NPAs at 120 days, right? By next financial year, it will become 90 days. So in the financial year 24-25, it was 150. Sorry, 120, 150. Now it has become 120. It will become 90 in the next financial year. So 90, they match all other regulated entities. Banks are on that. All upper level, middle layer entities are on 90%, 90 days DPD. So even base layer entities they used to be at 180 days. They have now been glide path on to 90 days. So this current financial year, 120 days and 90 days. Yeah, net owned funds is one of the basic things, right? At any time, net owned funds is required, right? So, for example, if the entity wants to write to RBI saying I have now crossed 1,000 crores, they have to both certify the net owned funds and asset size. Or at the end of every financial year, net owned funds, which is greater than 5 crores just now or 10 crores in subsequent years, has to be certified. You might be surprised. There might be cases where people are already sitting in middle layer, but due to certain quirks of accounting, they may not have net owned funds, right? So whether you are base level or middle level, this is a test that you will have to undertake on an annual basis. RBI does expect in the SAC. So apart from the DNPS trend that we are doing, statutory auditor certificate is made a part of the audit report that you give. So in that, they expect that saying you seeing that they have passed a regulation that they are not taking public deposits, you have seen that deposits there, you have seen the asset income pattern, and in your opinion, the entity is entitled to remain an NBFC and hold its license. So all these are part of what you say in a SSC report. So whether it's way past it or anything, anyway you have to test whether net owned funds are there. There are a couple of cases we've seen where net owned funds, even though there's capital adequacy, the net owned funds was a problem because they allow perpetual debt instrument for Tier 1 as well. Right? If you see some of that, then theoretically it's possible that you don't have net owned funds. That has to be tested. Yeah. We discussed this, I think 2022, as of 2022, base level, which is systemically non-important NBFCs, were at 180 days NPA, right? Slowly they have been tapered off to 120 currently, they will get tapered off to 90. So you will have to So there are a few very interesting things. The way they have framed it is that by 31st March of the year, they should be at respectively 150, 120 or 90. Question is, if they are reporting in June, if they are reporting in September, if they are reporting in December, should they be on the previous year's number or next year's number? So say this year is 120, previous year was 150. The 120 or 150 day requirement is as on 31st March of that respective year. RBI is telling, please report to me every quarter on 21st after the quarter what your position is. In those positions, are they supposed to be at next March's number or previous March's number? No clarity. Most of them will do previous because the glide path is for that purpose. If they are not ready on 31st March, they will not be ready on 1st April. They will need an extra time. Most NBFCs will do previous, but nothing wrong if you do next year. So it's just a little more aggressive than what application. We discussed this, but anyway, for completeness, I'll tell you. So, in the base layer and across all layers, say for even CICs, they have two concepts. One is public funds and customer interface. Customer interface is where you have direct interaction in lending or any other financial service with the customer. So, through a branch, through an app, through a website, anywhere, wherever you do, customer interface is there. Some things apply. Public funds is where you take any bank finance or you take any intercorporate deposit from any other company or some entities exist which accept public deposits. So even now there are depositing NBFCs, very few of them, but they are there. So then if you are doing all of that, then you are accepting public funds. So most NBFCs will be borrowing from banks. So then they might be borrowing. They might even have done an NCD with which individuals are part of. So then public funds are there, you have to follow certain things. If public funds are not taken and customer interface is not there, then you don't have to follow KYC norms, you don't have to follow fair practice code, you don't need a grievance redressal officer, you don't need grievance redressal mechanism. A bunch of operational things sort of fall away if in any of those layers you don't have. This is possible. Say your client is an investment company. Okay? They won't have a line. And if they are doing investments only out of, say, shareholder capital or accruals thereon, then they will neither have public funds nor they will have CA. So you can truncate the level of compliance required in those cases. Although RBI will ask you for full justification, you have to provide them an overview of how the business is running and make sure that you are able to communicate with PD and CI on it. Couple of things I want to cover about. So there are one of the horizontal guidelines that they have given is the appointment of auditor. So auditor appointment across regulated entities now part of one circular. You might want to, although it's not part of SPR, you might want to get familiar with that. There is no applicability of this up to base layer, right? So up to base layer, there is no requirement for rotation of auditor. There is no time cap. There is no conflict of interest. There is no cooling period. None of this applies for base layer. From middle layer onwards, it starts applying. So you might have to be mindful of how they are located. And anyway, there is adequate. You are familiar with all this. It's part of bank audit as well. You can't have your group entities being appointed. You can't have players where you are partnering two firms, the other firm, and you can conflict of interest. They anyway sort of take care. What happens
if it happens during the year, right, that was only transitional, you complete the audit for that year and then is out. There is also for the auditor, right, there are caps in terms of how many NBFCs you can do. You can do not more than one PSB, 8 UCBs and 8 NBFCs. 8 NBFCs, please remember, base level don't count. Base level NBFCs are part of your overall limit of how many audits you can sign. But 8 NBFCs greater than 1000 crores is the limit for the audit. Of course, if you've been doing this is again same as for all other entities. If you've been doing non-audit services, there's a cooling period of 1 year before you can be appointed as auditor of the entity. If there is interest, I can examine more how it's different between SBI and RBI guidelines and Companies Act. But otherwise, I think it's fairly well understood because I will see it in the context of bank audits and branch audits. The same circle. Basically, the same circle is applicable to UCBs, cooperative banks, scheduled banks, SFBs, payment banks, NBFCs, RNBCs, all kinds of companies are under the same circular for appointment. One other thing to mention in terms of auditors, so if you are upper layer, if you are classified as upper layer by RBI, then joint auditors are required, same as banks. Minimum of 2 joint auditors up to 15,000 crores. Later on, RBI might require more joint auditors. We covered some of this, but I'll just recap to you. So basically, I wanted to put all the auditor responsibilities in one place and just sort of show this to you. So basically, the responsibilities are as follows, right? Official responsibilities. Obviously, you do many more activities during the year to be able to submit all this. The first thing is your annual certification of net worth and asset size. Because the net worth and asset size certification is what determines whether entity is based layer, middle layer, some other, whatever RBI wants to decide beyond that. Right? So that becomes your main. The other things are that if you see various places in prudential norms, in capital adequacy, LTV, loan to value. So for example, if an NBFC is undertaking, a base layer NBFC is undertaking loan against securities, the maximum LTV they can give is 50%. Right, and all of these are separately required to be certified by auditors in respective places. So a bunch of certifications will be required there, and of course you have to sign off on provisioning and you have to sign off on everything else because you have to make sure as auditor that adequate disclosure, fair classification, fair quantification has happened on all of this. One other thing I think I already mentioned, but you will have to be careful in terms of both qualifications as well as emphasis matters, because unlike in many other types of entities, in the case of NBFCs, the emphasis of matter also might result in some financial implication for the NBFC. Most frequently, if the emphasis of matter is large enough, when credit rating agencies calculate a capital adequacy, they will deduct it. Most lenders will deduct it for capital adequacy purposes, etc. So, if it is serious enough, it is very important to quantify, even if it's simply an emphasis of matter. And do note that RBI has clarified a couple of times that when they do passport, even for like an NCD issuance or any other, they have to specify even emphasis of matter under what's called as qualification and provide the management response every time. So last 5 years worth of audit report will be there in the passport. Last 5 years worth of qualifications, emphasis of matters will be there, and the management response will be there within the passport itself. These are disclosures which are required to be made to incoming investors, even if you are doing a private business. Of course, everything that you do, you have to do on a consolidated basis. You have to make sure that the group is identified as one entity for all your classification purposes to evaluate whether you have to see based on the level, etc. And then whatever is the result, anyway, DN-based you are submitting to RBI. There are certain situations where, for example, if there is a significant material fraud, etc., where off the regular course, the auditor is expected to also separately flag off regulators, including FIU and RBI, Financial Intelligence Unit, as well as RBI. So those responsibilities are there. Apart from routine course, whenever there is change of management application, right? So we discussed that 26% change of management. Most frequently, RBI will ask for the latest financial position and the net owned funds network as on that latest position to be certified by the auditor. Now the question is, if I have not audited fully, can I certify only a portion of that which is net owned funds? There is no one answer. You will have to be not more familiar with auditing standards, etc. But you will have to make a judgment call this is that, because whenever there is an application, right, wherever I said application has to be made for prior approval with RBI, all of those applications, most frequently what they will do, any pending compliances as of that point, they will make you do it even before they say yes or no, and they will ask for net owned funds to be certified as of that. So both will happen. So multiple times net owned funds may be certified. Some final thoughts on your responsibilities as auditors. I've already discussed IT and audit systems, right? For significantly large NBFCs, the auditor may have to have their own corresponding audit tools, right? For sampling, for testing, for various different scenarios. Walkthroughs have been advised in the SBR for upper layer at least. The controls have to be done through a walkthrough. The operating risk guidelines also recommend frequent walkthroughs, etc. So these might not be something that you can manage with your routine audit tools. Maybe if audit tools, if you are doing audits of upper level entities, then this requirement, I'm sure, because only 15 years now, it will not be, but things can change. Leverage, liquidity coverage ratio, etc. are all liquidity coverage. By the way, I forgot to mention that 100 crores liquidity coverage ratio has to become part of the, until then it's optional in the DM list, becomes mandatory thereafter. So yeah, that is mandatory. Leverage anyway, you have to see. So there is a require, because of evolving guidelines and now they've consolidated fairly in SBR, there is requirement to see if the auditor also has to invest in certain technology to be able to understand. You may even agree with the company that they build a tool for you to keep monitoring some of this assurance, for example, on whether they are doing daily stamping on NPA, etc. is not possible if you go at the end of the year. One other tricky area, if you are working with group NBFCs, is related party transactions, right? All kinds of things will come. Your index will come, your requirements of disclosure, requirements of arm's length, etc. from NCA will come. Maybe there's some income tax angle, and there is also related party transaction norms from RBI in terms of what kind of arm's length pricing has, how it should be determined. Swiss auction, etc. they have mentioned in the SBR itself, but there it is not mandated, it is recommended. So the company may make its own method to justify that something is a fair practice or a fair arm's length price. The auditor will be required to take a look on that. Similarly on ECL, right? They have their own model to calculate expected credit loss, right? But that is something that you should be able to verify and agree with, because the provisioning that flows into the balance sheet after this is based on whether you agree with the management or not. Anyway, you have to make sure that it is at least whatever is recommended for that layer by RBI. So we discussed standard asset provisioning, which is 25 basis points, 40 basis points, 60 basis points for personal loans. Thereafter, it changes a little based on whether it is secured or non-secured. So if it's a doubtful asset, then if it's a substandard asset, then you have to calculate the value of the underlying collateral. Anything greater than that, that has to be provided for. Then if it becomes doubtful for 2 years, then you have to 20%, 30%, 50%. If there is no collateral at all, then anyway it's 100% provisioning. So all these extra layers of provisioning are there. NBFCs can be complicated animals, so these may not be loans that they have originated. It may be loans that somebody else has originated. You will have to have the ability to make sure that they are not doing the transfer for the purpose of revenue. It is not a treaty, it is actual true sale. Anyway, the true sale also requires a CA certificate at the time of transfer. So somebody has to give an opinion that once transfer happens, it's true sale and there will be nothing residual. It can be a legal opinion also, but CS can also be true sale opinion. So if that happens, then you have to make sure that if that loan had remained in the original books and there is a continuum. So the loan is a standalone entity. It is not cut off just because there was a transfer, unless RCL is buying it. Right? Unless an asset reconstruction company is buying it, there is no break in continuity. If there is any change, you may have to see if that tantamount to a settlement with the customer or a restructuring with the customer. There is a separate circular governing restructuring and settlements with customers. So those also have to be looked at. With the onset of fintech and mostly digital lending, loans are going out faster, approvals are happening instantaneously, customers are getting money without even the entity. Earlier they were doing video calls, now they are happy to do just this digital artifacts. Then the risk perception has to be different. Risk perception of RBI itself has changed. They have advised digital lending guidelines where it's very stringent in terms of what disclosures are there. There's a no-look period, right? So in which case, within 10 days, you can there's a period during which if the customer says, okay, I took the loan without fully understanding the terms, now that you have given me the welcome kit and the KFS and all, I read it, I don't want the loan, take it back. You are supposed to do it at no cost to the customer. All these kinds of extra levels of insulation have been made available by RBI in the regulation, but whether they are being complied with or not is something that you will have to determine. Anyway, every statutory auditor in the main report itself has certain items where either they say we have examined all the applicable regulations and company is compliant with it, or if there are any non-compliances, you will have to enumerate all of those. Some of this earlier, the fair practice code, KYC, etc. Most auditors are thinking it's something of line in the line of business, and the auditor doesn't need to take an opinion. Now things are changing. Mostly you will see, for example, I saw one recent one where the auditor had said that the company is using a third-party agency, right? So they're using a DSA. when you do physical KYC, original, sealed and verified has to be put, right? So an official of the company has to see the original PAN or original voter ID or driver's license, and then affix a seal at that point saying I have seen the original. The auditor has said that because that OSV seal is being affixed by the DSA, it tantamounts to the company outsourcing core function. Outsourcing guidelines say you can outsource so long as it's not a core function, so long as there are basic standards that your service provider will meet, and so long as you are taking ownership. Ultimately, RBI doesn't know your third party service provider, through you we will regulate it, right? So all these are there, but you can't outsource anything which is core. Although he not qualified, it was not a qualified opinion, but in the compliance section this was mentioned. There is no whole regulatory set of actions which are taking place as a consequence of that on the entity, because very large entity, 3,500 crore AUM, so very large entity. RBI is not taking these things lightly anymore. And if there are things that RBI doesn't take that lightly, if something comes to light later on, there will be the obvious question that whether this was noticed during the audit, whether this was highlighted in the audit report. So even stuff that is not part of the financial reporting, there is an expectation that broadly within the regulatory ambit, you are as auditors expected to take a view. We have covered what I intended to cover. If I think we have some 10 minutes left. If there are any questions, thoughts, we can discuss. By the way, there's a new circular called the co-lending circular. Most NBFCs today, in one form or another, are doing co-lending. I already described co-lending as something where, at the point of making the loan, two entities based on a ex-ante agreement come together and split the loan, either 80-20, 85-15, 90-10, and give the loan to the customer. That comes into effect on 1st January next year. There are significant amount of changes basis that, wherein as of now, whoever was originating NBFC was doing the civil reporting, the CIC, Credit Information Company reporting. Now each entity is supposed to do the respective portion of it as credit reporting. The other thing that was happening in co-lending, and this was also based on the earlier co-lending circular on private sector, was that there might be some change in the way the loan is shown in the books of the originating entity and the loan is shown in the books of the funding entity. Right? Now, as per this new circular, if the originating entity classifies something as SMA 0, the backend entity is also supposed to classify it as an SMA 0. They have to match exactly. Now, the problem is not matching. The problem is how do each of these entities make sure that the other has done the same thing that they have done. So it creates a whole new operating layer which they have to navigate. And there is one tiny piece there. They are saying that if for any reason the non-originating entity is not able to book that loan within 15 days of the loan being made to the customer, then the originating entity has to hold 100% of it automatically. All these are all fairly significant changes that require NBFCs to be technology savvy, how they are managing that. You have to make an opinion. Of course, it doesn't apply to 31st March 2025. It only starts applying on June 1, 2026.
DNB is 0.3, the risk weight is changed to 125%
Hmm.
personally. But in the return, they are not made to change this yet.
There is an error in the return. So what typically happens is you make it as for the because the template will not allow you to edit, and then you write a follow-up mail saying that this is an Excel with the accurate.
We are overstating.
You're overstating. You're overweighting the asset.
CRAR is overstated.
CRAR requirement is what?
CRAR ultimately ratio.
No. CRAR requirement is overstated. You might have less even if it's at 125%. So there's a difference. I think they have rectified, but as of now, what's happening is you reply, you capture the screenshot, you put the screenshot and say the return date allow me. And similar thing is there for DNPS 02 as well. CCDs are not available. The whole concept of CCD is not there. So various entities are doing various things. I recently saw one where they are putting the CCD in shares minimum. And then again taking the snapshot and sending the always saying this is not indeed the share premium, but it's actually CCDs which are yet to be converted. Conversion ratio is this, and therefore some gaps are there in the methods. Yes.
I would like to thank Raghav sir to take out his professional time and effort for such a nice and wonderful knowledgeable session given by him. I would like to request our chairman sir to please provide a token of appreciation for all these efforts from the Bangalore Branch. Please give a round of applause. Thank you very much, members. Thank you very much, members, for all your patientful listening to the topic. And one last announcement: we'll be having our Bangalore branch seminar, 20th Karnataka State Level Seminar, which will be held on conference, which will be held on 29th and 30th August. The next week, Friday, Saturday. Please do register for the event. We have only limited seats left. Please register as soon as possible. Thank you very much, everyone.
Thank you.